Welcome to CA Shiksha. This is Gaurav Santani and today we'll go through time value of money. Let's start with a simple question. If I ask you, what will you choose? 1000 rupees today or 1000 rupees after 1 year? If your answer is today, you already understand this concept. Your answer was just plain instinctive, but it is affected by the fact that if you invest rupees 1000 today, tomorrow you will have more than rupees 1000. Why? Let's see with this example. If I draw a timeline, rupees 1000 invested today will be more than rupees 1000 after 1 year. The value of rupees 1000 will increase with time, and rupees 1000 invested today will earn interest on it. So this value increases because of interest. When we say rupees 1000 invested today will be more after 1 year because of interest earned on it, but the question is how much this 1000 will be after 1 year. This will depend on how much interest is earned, and that depends on how much is rate of interest. It is better to say the future value of money depends on rate of interest. If we assume that the rate of interest is 10%, the value of rupees 1000 after 1 year, rupees 1000 plus interest at 10% on 1000, and that comes to 1100. Now that you know that rupees 1000 today is better than rupees 1000 after 1 year because of interest earned on rupees 1000 invested today. Now another question. If we ignore that you will make the investment of rupees 1000, another question, will rupees 1000 buy same amount of goods today and after 1 year? If your answer is no, you understand another point of time value of money, and that is the value of money decreases with passing of time, and this is because of inflation. Rather, it is better to say interest earned on investment also has inflation part in it. Means purchasing power of money decreases with time, and one motive of interest is to compensate this. If we say that because of interest at 10%, the value of rupees 1000 will be 1100 after 1 year, or future value of rupees 1000 after 1 year will be 1100, or reverse way we can say it is also correct to say that the present value of rupees 1100 after 1 year is rupees 1000 today. If we want to put all these mathematically, future value is equal to present value plus interest on present value, or future value is equal to present value plus present value into interest rate. If I take out of this from formula present value common, the formula of future value becomes present value into 1 plus interest rate. Or If I want to derive the formula of present value out of this, it will be present value is equal to future value divided by 1 plus interest rate. So far we have assumed that interest which accrues is a simple interest. If we assume that interest is compound interest, that means end of every year or period interest is added to the principal and new interest is charged on cumulative value. The formula of future value will be present value and 1 plus interest rate to the power time, or if I reverse it, present value divide is equal to future value divided by 1 plus interest to the power time. Let's do some examples to understand this concept better. What will be the value of 50,000 after 1 year if rate of interest is 10%? Future value will be present value plus 1 plus interest, present value into 1 plus interest, and that will be 50,000 into 1 plus 10%, that will come to 55,000. It's very simple. Let's do another example. What will be the value of 60,000 after 2 years if rate of interest is 8% and that is simple interest? Future value will be present value plus interest into time, because this is for 2 years, and here interest is 8% of 60,000, that will come to 9,600, and future value will be 69,600. Let's do another example. What will be the value of rupees 1 lakh after 3 years if rate of interest is 10% and that is compound interest? Future value will be, as per a formula, present value into 1 plus interest rate to the power years. In this question, 1 lakh into 1 plus 10% is to power 3, and it comes to 1 lakh 33,100. Okay, now let's do another example. What will be the present value of 1 lakh to be received after 2 years if rate of interest is 10% and compound interest? In this question, we are asking you about present value, not the future value. So, present value is future value divided by 1 plus interest is to the power years. It comes to 1 lakh divided by 1 plus 10% to the power 2, and it comes to 82,645. Now let's understand another important concept, annuities. First of all, let's see the definition. Annuities are essentially series of fixed payments required from you or paid to you at a specified frequency over the course of a fixed period of time. That means when a fixed payment is received or paid frequently over a period of time, it is called an annuity. So examples of annuity are post office recurring deposit. In this scheme, where you deposit amount periodically and you receive the payment at the end of the term along with interest. Another example can be investment in bond, where you purchase the bond and you receive interest periodically and repayment at the end of the term of bond. While making a decision on whether to go for an annuity or not, one need to know the present value or future value of the annuity. Now let's see what is the formula for calculating future value of annuities. The formula is future value equal to C into 1 plus I is to power n minus 1 and whole divided by I. In this formula, FV is equal to future value of annuity, C is equal to cash flow per period, I is rate of interest and N is number of payments. And how to calculate present value of annuities? The formula for this is C into 1 minus 1 plus I is to power minus n whole divided by I. And in this formula, PV is equal to present value of annuity, C is equal to cash flow per period, I is equal to rate of interest and N is equal to number of payments. Let's do some examples of annuities. If you are investing rupees 1000 per year for next 5 years at interest of rupees 10% per annum, what will be the value after 5 years? If I plot this example on a timeline, these are the 5 payments I will be making and I need to calculate present value or rather future value of all these after 5 years. If I calculate the 5th year value, in this case there will be no interest because at the end of 5th year you will receive the payment. So 1000 will remain 1000. Whatever we will pay at the end of 4th year and will be received after 5th year, that means 1 year's interest should be accrued on it. It will come to 1100. Same, 3rd year payments will earn 2 years interest. It will come 1210. 2nd year payment will earn 3 years interest. It will come 1331. And 1st year payment will earn 4 years interest 1464. So total of these will come to 6105. So future value of this annuity is 6105. Same thing if I use formula. The formula was this and I'm putting the values in this. 1000 is cash flow per year and 10% is the interest and n, that is number of payments, is 5. It comes to 1000 into 1.61051 minus 1 divided by zero point 0.1. It comes to, following these steps, it will come to 6105. Same thing. Now another question. If you are paying rupees 5000 per year for next 5 years and market rate of interest is 8% per annum, what will be the present value of rentals? If I plot this also on the timeline, payments are paid over 5 years, 1000 each year. First year payment will be discounted with 1 year time, that is 5000 divided by 1.01 is to power 1, that comes to 4630. Second year payment will come to 5000 divided by 1.08 is to power 2, it will come to 4287. Third year payment will come to 5000 divided by 1.08 is to power 3, 3969. Fourth year payment will come to 5000 divided by 1.08 is to power 4, 3674. And fifth year payment will be discounted for 5 years. It will come 5000 divided by 1.08 is to power 5 3403 and total comes to 19963. If we use formula for the same, formula for calculating present value of annuity is C into 1 minus 1 plus I is to power minus n whole divided by I. Yes, C will be 5000 and the rate of interest is 8%. So the value comes to, through all these steps, value comes to 5000 into 3.9925 and the final value is 19963, same what we calculated through picture. Another example, you have been given the option to receive rupees 1 lakh now or rupees 25,000 per year for 5 years. Which one will you choose if rate of interest is 10%? You need to see if I calculate present value of annuity of 25,000 for 5 years. If it is more than 1 lakh, I will choose that option. Otherwise, I will go for 1 lakh. So calculate the present value of 25,000 per year and compare it with rupees 1 lakh. Same formula. 25,000 into 1 minus 1 plus 0.1 is to power minus 5 whole divided by 0.1 and the value comes to 94,770. That means it is better to receive rupees 1 lakh today. Let us revise. The value of money changes with time. This change is because of interest. The value of money decreases with time if not invested because of inflation. Annuities are essentially series of fixed payments required from you or paid to you at a specified frequency over the course of a fixed period of time. This is end of lecture 1, time value of money, CA Shiksha exploring new heights of learning.